So we are going to learn about financial condition analysis. It is an important characteristic how to assess a financial condition of an organization, and that is why we need to do the financial condition analysis. We need to know if the hospital has the financial capacity to perform their mission to meet their goals, especially financial goals. It is a very important thing for managers to know, as well as for stockholders to know, including investors, employees, and the patients that are served, whether the financial condition of the healthcare organization is appropriate, good, or healthy. You might have heard about a lot of mergers and acquisitions. So sometimes when organizations are not financially viable, they end up getting merged or getting acquired by another organization. And that brings a lot of changes in the quality of care, in the morale of the employees, as well as affects the communities that are being served. Financial condition analysis consists of several techniques. The first one is financial statement analysis, and that focuses on the information in a business's financial statements with the goal of assessing financial condition. The operating indicator analysis focuses on operating data with the goal of explaining financial condition. So in the financial statement analysis, the first thing we are doing is assessing the financial condition. And when we actually start looking at the operating indicators, we are trying to explain the financial condition. So to understand this better, let's look at the data for Riverside Memorial Hospital, um, and all of this data is in thousands of dollars. So I'm sorry again about the neighbor's dog. As soon as I start recording, they start barking. So, all right. So this is the income statement. I'm wearing a headphone, so hopefully this is a little bit better. So this is the income statement, and as you can see, it's in thousands of dollars. There is revenues, there is expenses, there is operating income, and there is non-operating income. So the total operating revenues are listed, the total expenses are listed, and the net income is a combination of the operating income as well as the non-operating income. And so you have the total net income, which is 8,572 for 2020 and 2,395 for 2019. Now this is the balance sheet, and that shows the assets. So we have the cash equivalents, short-term investments, accounts receivable, and inventories. That gives you the total current assets. We also have the gross property and equipment and accumulated depreciation, which gives you the net property and equipment. And so we have the total assets as 151,278 for 2020 and 148,000 approximately for 2019. And we also have the liabilities and equity portion. Remember, the assets is on the left side and liabilities and equity is on the right side. And the purpose of the balance sheet is that it should balance. So the accounts payable, accrued expenses, and notes payable show the total current liabilities at 13,000 approx. We also have the long-term debt, finance lease obligations. That gives us the total long-term liabilities at approximately 30,000. And then we have the equity, which is $107,000. So the total liabilities and net assets equals 151,278 for 2020 and 148,650 for 2019. And finally, we have the statement of cash flows. Cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities, right? Those are the three components of the cash flow statement. So for the cash flow, you can see that the net cash flow from operations is 9 million. Over here it's 9,098. So the operations provided 9 million in net cash flow in 2020, and Riverside invested 4.3 million in new fixed assets and 2 million in short-term securities. And the cash flow from financing activities is listed here. So the net cash flow from financing activities is 3,637, and the ending cash and cash equivalents, as you can see, is 2,263. So operations provided about 9 million in net cash flow in 2020. Okay, so the net cash flow from operations is on page 671, last line, as you can see, 9,098. Which is actually 10,604 minus 1,297. So 6,474 on the operating income, and the depreciation 4,130. If you add that, you will get 10,604, and then you minus the 1,102 plus 195 plus 438, and that gives you 1,297, and then you end up having the 9,098 as net cash flow from operations. Riverside repaid about 5.5 million in short-term and long-term debt financing, and that 5.5 million is 2150, which is under cash flow from financing activities, repayment of long-term debt, plus 3262, which is the repayment of notes payable, and the 323 from the lease principal repayment. We added all of that to get the amount that Riverside used to pay off their debt, which was about 5.5 million. In addition, the hospital generated about 2 million in non-operating income. 2 million in non-operating income, you can see that it under cash flows from financing activities. So the first line for cash flow from financing activities says about 2 million, so 2098. And the ending cash and cash equivalents is 2263, as you can see. That is the very last line. Now, whether hospital operations are self-sustaining or not, whether the business is generating cash necessary to pay its bills, all of that is told to us by the ending cash and cash equivalents. Okay. So the financial ratio analysis, these are single numbers that measure aspects of financial condition, and that is why they have financial significance. Ratio analysis is a technique that is used in financial condition analysis, and financial ratio analysis combines values from financial statements to create those single numbers. They are easy to interpret, they have economic significance, and they also help us compare one organization to the other one much better. A single ratio value has little meaning. For example, if you say a total profit margin of 7.3%, yes, it tells us that every dollar you invest, you make 7.3 cents in revenue. So that was, if you remember, that was the interpretation of a profit margin. But if you have more such numbers, then we can interpret the numbers better. So there is two techniques that are used to help interpret the numbers. The first one is trend analysis, and the other one is comparative analysis. To assess relative performance, many healthcare organizations compare their financial ratios with the average or median values of ratios for similar organizations. For example, Optum publishes 5-year trend information on financial ratios. Even though we called comparative data averages, they are median values. Median values are non-biased by extremely high or low values in the data set, so they are better than average. Both techniques will be illustrated in some of the examples that we're going to see. Profitability is basically telling us if the business is generating sufficient profits, and liquidity tells us if the business can meet its cash obligations. Debt management tells us if the business is using the right mix of debt and equity, and asset management tells us that the business have the right amount of assets for its patient volume to meet its patient volume. So the total margin is a profitability ratio, and operating margin is also a profitability ratio represented by OPM. So for 2020, you can see that the total margin is turned out to be 7.5%. Total margin measures the ability of the organization to generate revenues from all sources and to control expenses. So, if everything else is equal, the higher the total margin, the lower the expenses. Operating margin focuses on core business activities and it removes the influence of financial investment, gain, and losses. So it does only considers the patient care activities. It does not consider the profitability that you are getting from investing in stocks or land or building or anything like that. So here you can see the for 2020 they have a total margin of 7.5%, Riverside Memorial Hospital, and they have a operating margin of 5.8%. Total margin measures. The return on assets is the next profitability ratio, and the return on equity is also another one. Return on assets is the ratio of net income over total assets, and that is 5.7% for Riverside, and that tells us that each dollar of assets generates 5.7 cents in profits, and the return on equity is 8%, and that is represented by ROE, and it tells us that the hospital was able to generate 8 cents of income for each dollar of equity. And for profitability ratios, we have a list over here, which includes the total margin, the operating margin, the return on assets, and the return on equity. For 2020, we have the numbers, and we also have the 2019 numbers. We also have the peer group average. So we have the percentage of the peer group, right? So we have the average that was peer group from the peer group. So total margin shows that it is better than peer average. We have a 7.5% in 2020, which is better than 5% because probably the charges are relatively high for Riverside. Their costs are relatively low and they do not have operating revenue, so there is no operating revenue, which is relatively high, and or maybe a combination of these factors. So total is 7.5% for total margin, but the operating margin is only 5.8%, which means that removing investment income lowers profitability, but it is still better than peer average. The return on assets is 5.7%, which tells us that each dollar of assets generates 5.7 cents in profit, better than average again because it is higher than 4.8%. The return on equity is less than average, it's 8%, but the peer average is 8.4%. The dew point analysis will show that inconsistency between return on assets and return on equity is because of hospitals' low use of debt financing.